All right, so in this video, I'm going to talk about systematic risk. So systematic risk is also known as market risk or non-diversifiable risk. So it's basically it's the risk that's sort of inherent in the system, if you will. And basically the idea here is it's risk that affects investments broadly, whether that's stocks, bonds, projects, real estate, whatever. It's the types of things that tend to affect broad groups of investments. So think things like, war, inflation, recessions, interest rate fluctuations, all those kinds of things basically tend to affect investments broadly. So with systematic risk, what's important with this is basically you can't really eliminate systematic risk for the most part. You can decide sort of how much exposure to systematic risk you have, but you can't really eliminate it. So let me give you an example. You could invest in stocks, which have a lot more exposure to the risks of the economy, or you could put all of your money into a FDIC insured savings account. So you sort of decide sort of how much exposure you want there. In the case of the FDIC insured savings account, that's about as close to a risk-free investment as you get. You're basically saying, I don't even want the systematic risk. I just want to sit here and get a small amount of interest. But you could kind of progressively go from 100% in that risk-free investment to maybe 50% in the risk-free investment, 50% in stocks. And at which point you now have more exposure to the systematic risk. And then you can go all the way to 100% in stocks, in which case you got a lot more exposure to systematic risk. Obviously, as a side note, I can't help myself, and I must feel compelled to point out that you really pretty much almost should never have 100% in stocks. You should probably have some other asset classes in here, maybe some bonds or maybe some real estate, throw some things in there, because if you go back to the prior video I talked about in terms of like the two asset example or risk, correlations affect risk, and it's possible to actually get a better risk return combination by including things that aren't perfectly correlated, and different asset classes are not perfectly correlated generally, so you can get some better portfolios there. But I digress. Anyway, so basically, you can sort of decide the level of systematic risk exposure you want to some extent. So whether that's going with a bank account or equities or stocks, in other words, and what combination of that. So you kind of can set your exposure to the systematic risk, but it's not really getting rid of the systematic risk. Now, there are some money managers that try to kind of sidestep some of the systematic risk or manage that a little bit by doing long-short hedging portfolios. And the general idea here would be they're going to try to find investments that they think are undervalued, meaning that they're worth a lot more than what they're selling for. And on average, the market would be expected to correct that, meaning that the price should go up to that value. They're also going to try to find things that they think are the price is way too high for relative to the value. And they're going to do something called short selling that. So they're basically they're going to borrow that asset, sell it at the higher price, hope to buy it back at a lower price and replace it to whoever they borrowed it from. And so the idea would be, theoretically, if the market went up, which is more of a, just due to big economic circumstances, then the investments that they were long on, in other words, the investments they bought because they thought they were worth more than the price, would be expected to go up by more because the price was kind of too low to begin with. And the things that they had borrowed and sold because the price was too high, the thought would be the price wouldn't go up as much because the stock or investment is already too high relative to what it should be. And so the thought would be they would make money if the market went up. But then if the market went down, the things that were overvalued, that were the price was too high relative to the value, that should drop by more, because it should drop even if the market went nowhere, because the price was too high. And the things that were undervalued, well, even if the market's dropping, price shouldn't really drop that much because the value was already way higher than the price anyway. And so the thought would be they would make money even if the market went down. Now, that sounds great in theory. So the theory between kind of some of those long short portfolios is that I basically should make money if the market goes in either direction. The reality is the person who is pursuing that strategy kind of has to be right twice. And not only do they have to be right, but things have to happen in the market just the way that they need them to. And so basically what has to happen in that case is the things that they think are worth more than they're selling for, they have to be right about that. And then the stuff that is they think is actually selling for more than it's actually worth, they have to be right about that. And then things have to actually correct. And so the reality is, maybe that affects systematic risk exposure, and it would affect what would happen if to the your portfolio if the economy is going on. But the reality is you have to be right a lot, and the market has to kind of correct its mispricing for this to work out. So the end result of that is not necessarily clear cut that that's really going to help you sidestep systematic risk here. Then we might have another thought, which would be, all right, well, maybe the thought is we try to do market timing to avoid systematic risk. So if we've got big concerns about recessions, well, why don't we just sell before the recession hits? And then after the recession occurs, why don't we just buy right at the end of the recession? And then we just sort of avoid the whole recession, and then we avoid the systematic risk there. What's wrong with that? Well, that's another one of those things that sounds great in theory, but in practice, the problem with this is correctly figuring out exactly when a recession is going to hit and when it is exactly ended in the moment is a lot harder than it sounds. So that idea sounds great, but the reality is there have been lots of finance studies basically trying to determine whether people can sort of time the market, sort of sell at the top, buy at the bottom. And basically what it boils down to is between experience and studies, the probability doesn't look good. So history and experience tends to suggest it just doesn't work real well. People tend to have a pretty poor ability to figure out when we're right at the top or right at the bottom. So that tends to not work the best. So that brings us to arbitrage. Arbitrage is an interesting idea. So the arbitrage is technically a situation in which you have zero net investment. And since you have zero net investment, it's therefore riskless because you technically have no investment, but you got the possibility of a positive profit. Well, that sounds good, right? How can I have zero net investment and a possibility of positive profit? I mean, this is sounding great, right? What's the catch? Well, so let me give you an example of sort of what arbitrage would look like. Let's suppose you discovered that you could, let's say that there was a stock that was trading on a stock exchange. Say it's trading on the New York Stock Exchange. Stocks also, you may not realize this, trade on some regional exchanges as well. So let's suppose that there's a stock that is trading on the New York Stock Exchange, and it's also trading on a regional stock exchange. And let's suppose you happen to notice that the price on the New York Stock Exchange is a bit higher than the price on the regional stock exchange. Well, being the enterprising individual that you are, it would occur to you that you could simultaneously enter a transaction to buy the shares at the lower price on the regional exchange and simultaneously sell those same shares on the New York Stock Exchange at the higher price. And then you would pocket the difference. And basically, since you bought and sold at the same moment, you don't have any net holdings of stock. You basically just bought and sold the same shares, and you just pocketed the difference in price. You have no risk. Well, that sounds great, right? I mean, this is basically arbitrage. That's the idea. You've got zero net investment, possibility of a positive profit. And this actually is a thing. People actually do try to do this. The problem with this is it's really kind of attractive if you can pull it off, but the opportunities tend to disappear extremely fast. And by extremely fast, there are basically financial institutions that have think supercomputers working on analyzing all of these possible price discrepancies to see if there's any little tiny discrepancy of even fractions of a penny or something that it can try to exploit to do this with. And so it's going to disappear extremely fast. So if there's any little tiny disconnect between, say, a regional exchange and like the New York Stock Exchange, then that gap is going to disappear incredibly fast. So there is some money to be made on it, but it's extremely competitive and takes a huge amount of resources to try to find it, and they don't last very long. And if you're kind of wondering, like, well, hey, these people have all these resources, they can make money on this. Well, the reality is because of the fact that they are trying so hard to find that, generally you don't actually have these discrepancies last for very long at all. And the benefit to the average investor is you don't get big price discrepancies. And basically, pretty much the price is going to be pretty much uniform across the different exchanges, because if there's any little disconnect, it's going to get pushed back into equilibrium again by somebody trying to take advantage of that discrepancy. And because you have people trying to take advantage of any little tiny discrepancy, what happens is there's actually a lot more trading volume. So there's a lot more shares are changing hands. And the benefit of that for the regular small investor is if I put in my order for 5 or 10 shares, it's just a little proverbial drop in the bucket compared to all the shares changing hands across all the different financial institutions and anybody who's trying to find these little opportunities. And the advantage of that is basically transaction costs are lower for the typical investor as a result of that. And so that's a benefit that you would tend to expect from that. So it's extremely competitive, doesn't last very long. We don't see big price discrepancies very much as a result of that. They tend to disappear, I think more in the order of like milliseconds or something like that. It's vanishingly fast. But the benefit for the average investor is basically when you put in your orders to buy shares, you basically face lower transaction costs because there's more shares changing hands, which is kind of good. So ultimately, if you kind of circle back to systematic risk here, basically what that boils down to is they're not really great ways you can get rid of systematic risk, right? The long short hedging portfolios, that may not work. Market timing, that's got a terrible history. Arbitrage, it's a thing, but it's wildly competitive to try to find those and last for very little time. So really what it kind of comes back to is you can kind of decide what level of systematic risk exposure you have based upon what kind of portfolio you construct. In other words, what do you invest in affects how much exposure you have, but you can't really get rid of systematic risk. It's just a matter of how much of the risk do you want to have? So it's not eliminating it, you're just deciding how much you want to expose your portfolio to, basically. All right, hopefully this video about systematic risk has been helpful. Thank you so much for watching and have a great day.